coffee break that I'm doing each week here. So I'm Neal, and I'm the founder and chief tax strategist over at Tax Sherpa, where we help people keep their money away from the government. And the whole idea there is that, in my opinion, handing money over to the government does not lead to good things. And so I think it is incumbent upon all of us to use the rules to our advantage the most way possible in order to not only just keep money for ourselves as opposed to turning it over to the government, but also doing that, it actually makes the world a better place. So that's how I approach things. And yeah, so I started doing these live streams. I used to do some live streams back on YouTube primarily, and I just got busy and got away from it. So I decided it was time to start streaming again, and I was really inspired by a buddy of mine, Qasim Aslam. He runs the 3X community over on school.com, and what he was talking about inspired me to say, yeah, I should get back to doing that because it is a great way to touch base on things and keep everybody in the loop as far as what uh, what is happening in the world. Because we get questions all the time from clients, and there's laws being changed, there's tax court opinions, there's reports coming out, there's notices, there's always something to talk about. So I thought I would just take a few minutes here and just go over those each week. And it doesn't have to be a big thing. This is just a coffee break. And I've got my mug right here. Although I actually don't drink coffee. I never developed a taste for it. So for me it's tea. But you can use the same thing. All right. So a couple things I wanted to go over this week. And some of them are terrifying and some of them are not. So in order of severity, two reports I want to go over. One was from the CBO and one was from the GAO. So the CBO, the Congressional Budgetary Office, they had a hearing in the Senate. And what they were saying was that Social Security is going to run out of money in 2032. This is slightly different than the report from the trustees of Social Security, who, in the most recent report, they said it's 2033. So, whichever, they have slightly different assumptions baked into their models, so they come up with slightly different dates. But at that point, then there will not be enough money in the Social Security system in order to pay benefits as promised, right? So the main thing there is that the over the course of history, from when Social Security was created, people were paying in Social Security taxes. So when you get a W-2, there's that line that says FICA or Social Security tax or something like that. And that money went into the so-called trust fund for Social Security. And the trust fund did a couple different things. So one is it paid current benefits. So people who have this idea that I paid money into Social Security and therefore there's money set aside for me, that's not what happens. Your money goes into the pot and then it gets paid out immediately to people receiving benefits today. Ida Mae Fuller was the famous case study. She paid in, I think she made one Social Security payment, which made her eligible, and then she collected benefits for 20 years or something until she passed away. And so over the course of history, from 1936, I think, up through about, I forget the exact year, 2010, somewhere in there, there was more tax money for Social Security coming in than was going out for payments. And that created a surplus, right? That was the trust fund, what they call the trust fund. And Congress, of course, is not going to let that money sit around. So the rest of Congress borrowed money from the trust fund. It gave an IOU to the trust fund, say, hey, you can get paid back, according to this interest rate. And starting around 2010, I'd have to look up the exact year, but starting around 2010, Social Security, the incoming tax money was not sufficient to pay out the benefits anymore. So they started cashing those IOUs in from the rest of Congress. And that has been the process up through today. And they're saying in 2032 or 2033, depending on which report you look at, those IOUs are going to be finished. And at that point, there will only be enough incoming tax money for Social Security to cover about 77% of the benefits that are promised to retirees, mostly retirees. There's, a couple other people who receive Social Security, but retirees are the vast majority. So, what happens, right? And this is not a new problem. People have known about this for decades, and it's been in these reports year after year after year. But now we're coming up on the time, right? So that's really the change in tenor of these reports, because Trump's going to be out of office at the end of at the very beginning of 2029, and then whoever the next president is elected in November of 28 will be sworn in January of 29 and will be president until beginning of 2033, right? So the next president is going to have to deal with this issue, even if they've been kicking the can down the road, for decades now. So for those of you who recall the prior Social Security reform, what they did was they changed the full retirement age. So if you are born more recently, then your full retirement age, at which point you collect the full benefits of your Social Security earnings, is 67, basically, as opposed to 65. And this is all driven by demographic shifts, where people are living longer and people are able to, collect more benefits fundamentally. And so the whole population is aging in the US. And so something has to happen. Either benefits get cut because there's only enough money to pay 77%, or benefits get cut by changing who receives what. So there might be a means testing, there might be an age change, there might be something like that. So the net payouts that go out are reduced. Or taxes will go up to pay for that shortfall, or the government will borrow and spend and create inflation in order to cover that gap. Now, um, item number one, where the current recipients get their benefit cuts, I think it's technically possible, but in realistic politics, I don't think there's a chance that they're going to let that happen, because people who are retired vote in higher proportions than other groups of the population. So by cutting current recipients' benefits, I mean, that's just political suicide. So I don't think they will do that. Changing the retirement age and doing a stealth benefit cut in that way, sure, that's totally on the table. I would not be surprised to see the full retirement age go up to 70. And they do this in staged forms typically, so that it doesn't hit all at once. And that was the same thing in the change from being 65 to 60. I think it's now 67 and 6 months, or depending on what year you were born in. So I would not be surprised if they do something like that. And the raising taxes, I think, is a strong possibility, because right now there's a cap on Social Security earnings. So if you make about $200,000 on a W-2 or a collection of W-2s, then uh, the Social Security tax stops. And then as you make more than that, the Medicare tax continues and the income taxes continue, but the Social Security does not. Social Security is a significant part. It's 12.9% between employer and employee. So that could very well be. And I did the math several years ago on this, where if the cap on Social Security earnings were removed entirely, you get about 2 more years out of the system before we hit this, before you hit this benefit cut point. So strong possibility they do that. Of course, that'll be very unpopular. It also will interfere with QBI optimization strategies. So just slight tangent here. QBI is qualified business income. If you own a pass-through entity like an S corporation, and you're making a significant amount of money, then the wage that you pay yourself as the owner gets factored in to how much qualified business income deduction you get from the profit of that pass-through entity. And so there is some math to be done there as far as balancing the W-2 versus the profit in order to maximize that deduction. And sometimes, under the current law, it's better to raise your salary because you'll get a more deduction. But that hinges a little bit on the Social Security cap. So if that goes away, then that math will change. And then the borrowing and spending, I think, is highly likely as far as covering that spending gap. So I think it's going to be some combination of those three things. We're going to have tax hikes, we're going to have inflation, and we're going to have a benefit cut through reducing the people who can qualify by raising the retirement age. I think that's kind of some combination of those things is what's going to happen. And like I said, people have known about this for decades, but every time the report comes out, they say, oh, well, that's in 20 years or that's in 15 years. And now it's in 6 years. So the next president, next administration is going to have to deal with it one way or the other. And I think whatever way is going to be is going to be politically painful because regardless of how you approach the problem, the the fundamental structure of the program is not sound. And so there's going to be a reduction in payout in some form or fashion. If it's inflation, your purchasing power gets eroded. If it's taxes, well, then your taxes go up. If it's benefit cuts by raising the retirement age, then just straight up the total payments over the course of a lifetime are going to be reduced. So uh, that's kind of where we're at. Um, there was another report that came out with from the government, the GAO, the Government Accountability Office, this past week. Let's see. This is my first time using Riverside as a host, so let's see if I can figure out how to do this. What I want to do is I want to share screen, and I want to go to this tab. Okay, so I think this is showing up. Yeah, okay. So the GAO did a report on artificial intelligence inside the IRS. And the subtitle here is IRS Actions Needed to Address Skill Gaps, Information Quality, and Strategic Management. And this came out, as it was Tuesday. So this is the summary page, and it is, to me, it's a little bit hilarious, a little bit terrifying. So fast facts. The IRS has been using AI to help with its operations, including audit selection and answering taxpayer questions. It plans to use AI more in the future, but it may not be ready to do so. We found that staffing reductions resulted in IRS not having enough skilled employees to support or develop new AI tools. IRS doesn't have a workforce plan to identify and address the skills its AI workforce needs. Also, IRS's inventory of AI applications was incomplete. For example, it didn't include all the ways that AI was being used to identify how the tools would benefit the agency. Our recommendations address these issues and more. So here's the thing. So they did a study up through June 2025, and the IRS had 126 artificial intelligence use cases, applications for a particular business need. Business is in quotes because this is not a business, this is a government program. And they give a little breakdown here. So 59 of those 126 were operational efficiency, which, okay, fine. I think that's a good use case for AI. 43 were in tax compliance and fraud detection. So they're trying to figure out who is not reporting things correctly and creating, audit scope. And then 24 is taxpayer services. So so in 2025, we had the Doge initiatives. A lot of people were laid off. A lot of people took early retirement, and they're saying major staffing reductions at IRS in 2025 could greatly affect its ability to use AI. For example, officials in the research, applied analytics, and statistics group said they lost 63 employees who had been working full or part-time on AI. And so they're going through all this stuff, and then they have recommendations. We'll get to the recommendations here in a second. Here's the part that I find terrifying, is the taxpayer services. What that is talking about is answering people who call or write to the IRS and, asking some question. So I don't know if you've ever called the IRS. It's not a pleasant experience. And so what it sounds like they're doing is, there'll be a phone rep who is answering a phone call, and they'll be typing something into some kind of AI engine. We don't know what. And they're giving some answer. Now, as we all know, AI is not 100% reliable. It's getting better and better, but this report says they've been using this for years, right? Going back to 2022. So, it's a little bit crazy to be admitting to the fact that they are using AI to answer taxpayer inquiries. Because of the problems with hallucination and the problems with just factual errors. So I've caught AI a number of times, giving factual errors on questions that I asked. But the difference is that I know how to, push back on the AI in order to get the right answers. In addition, IRS's inventory did not always include quality information. For example, GAO determined that over 25% of the use cases did not include information on how the use case was to benefit the agency. So the GAO is saying we couldn't even get an explanation as to what the benefit was for, one out of four use cases. So this report, I think it'll probably be pretty much swept under the rug, but it's pretty damning. And then it goes on to the recommendations, and these, any kind of these government reports always has recommendations like this, where the recommendation is the Commissioner of Internal Revenue should identify the skills the agency needs to support its use of AI and develop a plan to address any related skills gap. The Commissioner of Internal Revenue should ensure IRS has a comprehensive quality assurance process for AI inventory entries, including mechanism for documenting complete and quality information. I would agree with that. That's just good practice for anybody. And there's a bunch of these other ones. The problem with this is that there is no commissioner of internal revenue right now, because there's been so much turnover in the agency at the executive level that Lutnick, or no, not Lutnick, but Besant, had been on a temporary assignment, and now they have this CEO character where that position doesn't actually exist in the IRS. So this report is going to nobody. So so that's the kind of stuff that we're dealing with here, and it's just crazy to look at. So the IRS is using AI in some form or fashion. They can't explain how they're using it, and the recommendations on how to improve that is going to nobody. So that's the state of things at the IRS. So things to be aware of. So those are the two terrifying reports. So one was Social Security going bankrupt, according to CBO, sooner than the trustees are saying, and GAO is saying IRS is using AI in a totally unexplained, not totally, but mostly unexplained and dubious nature. So there's that. All right. One other update that the IRS announced, I guess it was this week, saying that there's $1.2 billion in 2022 refunds that are expiring. So if you're getting a refund, you basically have 3 years at which to claim that refund from the IRS. So 2022 taxes, the due date was April 15th, 2023. 3 years past that is April 15th, 2026, which we're coming up on. So if you are due a refund from 2022 and the IRS says there's about $1.2 billion of refunds still to be claimed, then you want to get those returns in as quickly as possible so that you can claim your refund. Now, the good news about the 1.2 billion in refunds that the IRS says is sitting there is that that's only about 0.33% of the refunds that were allocated to 2022. And so all in all, it's 1 in 300 um, pieces of the refund that are left. And the median amount of refund was about $650. So it's not a huge deal for those people who haven't filed yet, but get your money back for sure if you haven't already. So yeah, those were the updates. And I was talking to my team earlier this morning about the GAO report, and Serena, who's one of our managers here, she pointed out that she saw a post on LinkedIn from the IRS account saying not to rely on AI because it's unreliable. So it's kind of funny to kind of see that, well, you guys are using it, and apparently for taxpayer questions. So that is a question to figure out. Let's see here. The other thing that I wanted to hit on real quickly is we got kind of well, actually three different questions that came in that I wanted to make a special note of. So one was on inheritance, and how does inheritance affect your taxes? So there's kind of two different buckets when it comes to inheritance. So bucket number one is that the recipient of an asset, like a stock or like a bank account or like a piece of property, um, is going to get what's called a step up in basis. So, if you inherit a stock brokerage account just fully, and it's worth $100,000 on the day you inherit it, then your cost basis is $100,000. If you turn around and sell it immediately for that $100,000, then you have no gains whatsoever because the cost basis and the proceeds are the same. So the difference is going to be zero. If you inherit that and then hold it for 5 years and sell it for $200,000, then you're going to have a $100,000 gain from 100 to 200. And the same thing applies to property, and the same thing applies to cash. Cash, obviously, you're not going to get a gain on because if it's $50 bill, then it's still a $50 bill. Okay. The other bucket to consider when you have an inheritance is a inherited retirement account, like an IRA. And under the Secure 2.0 Act, then you have 10 years with which to draw down the funds in that account. There had been some back and forth. Can you wait till the end of the 10 years, or do you have to do it evenly? And basically, the resolution was that it has to be done evenly. So you have to, if you want to do the 10-year plan, I mean, you can draw it all out immediately, but it gets, if it's inside of a retirement account, like an IRA, then it becomes taxable income to you. So those are the two different buckets. Um, as far as inheritance goes. And then the mistake people make is, if you're elderly and you want to give assets to your kids or your grandkids, if you are gifting assets, then you are giving them your cost basis. And maybe there's a gift tax issue, maybe there's not, depending on the amounts that are involved related to your total estate. Um, in most cases, most people are not going to have any estate tax issues because the threshold's now 15 million for a lifetime exemption. And but the problem is that when you give somebody a stock or a piece of property or something while you're still alive, then those people get your cost basis. So if you bought a house in 1990 for $50,000 and now it's worth 500, and you gift that house to your grandkid or son or daughter or whatever, then their cost basis is now $50,000. So if they turn around and sell, they're going to have a huge capital gain. But if that process happens after you pass and it's through an inheritance, then they have the step up in basis. So that's something that we see people mess up on a lot. And so it's better, in my opinion, it's better just to, if you want to do that large gift, sell the thing, you deal with your taxes, and then gift the cash, and then everything is much cleaner. Um, Another question that came in just this morning actually was on renting an apartment for a business, and that's, generally speaking, is fine. You might run into issues where the owner or the property manager doesn't want a business to rent the apartment. So there can be some quirks with that. If it ends up being required that the only way you can get the job done is to get the rent in your personal name, then you have to do the reimbursements from the company to the personal name through an accountable plan. And accountable plan is under section um, 162-2, if I remember correctly. And basically, this is like anytime you turn in a receipt to a business and they reimburse you, that's an accountable plan. So it's very commonly used to expense those items from the business that were incurred at the personal level. And there's a lot of things you can do with that if you own your own business, as far as the things that you are paying for personally that have business use. So that's one mechanism to do that. And the other thing is just to, if you are renting a residential property for business, you want to make sure that nobody could come in later and say, well, you're actually getting personal benefit out of this. So you don't want to have a bed in there. You don't want to be staying there overnight. You want to keep it just business for business purposes. And that way that'll keep everything clean. And then the third question I wanted to go over that we got this past week was on foreign assets. So somebody wrote in saying that they had a property, I think it was property in Portugal, and then they had bank accounts in another European country. And so there are two different reporting regimes for foreign assets. So one is the FBAR, and that's the DOJ, and then the other is FATCA, that's through the Treasury. And they kind of cooperate with each other because you can file your FBAR with your tax return if you choose to. You can also file it separately if you want to. And what I ended up doing was in the school community, which I will add into the resources under this live stream here. If we go into the school community, as I'm adding modules rapidly here, let's see if I can share screen. Oh, share. There we go. So I put in an FBAR and FATCA navigator, and this is of course just kind of going over the two different tracks here, and what the filing thresholds are for each one, and um, and then how you do each one. So for the FBAR, which is FinCEN form 11 or 114, It's a $10,000 threshold. There is some gotchas in it, in that you have to look at the high balances per account if you have multiple accounts. And then FATCA, which is IRS Form 8938, which generally has a $50,000 threshold. But you can go through all the details there. So the thing about both the FBAR and the FATCA is that, well, two things. So one is that uh, real estate, like if you own a property, or this happens a lot with immigrant families where, mom and dad own a place in Greece, and they put their kid's name on it, or they pass away, and then three or four kids all inherit shares. None of that's reportable because real estate is property, so it's not a financial asset. If there's a bank account associated with that property, like it's renting, then that bank account might be reportable. And there's some slightly different rules for cryptocurrency held abroad and under the two different regimes, FBAR versus FATCA. So little nuances there. But either way, neither one of those assess a tax. So there's no fees for having, or special taxes for having assets in foreign jurisdictions. They just want to know, right? So ostensibly, the explanation is that they're combating money laundering and they're combating terrorism financing. My interpretation is, if they ever want to come after you, they want to know where all your stuff is, fundamentally. And so the penalties for not reporting are severe. And it depends on if you're willful or non-willful and things like that. But it's definitely not worth the penalties. So you do want to get into compliance as best as you can. So you can check out the course I put in there on the school.com group, which is the Tax Strategy Network. And that's free for everybody. So there are a couple things in there that are gated. And what I've been doing this week, and this is the path I'm doing going forward, is that educational material, like what things are all going to be on the free level. And then for implementation, like checklists and first do this and first do that, SOPs, things like that, those will be gated to our navigators or tax planning clients. Um, so, but if you want to know about how all these strategies work, that'll all be open to everybody. All you got to do is join the Tax Strategy Network group in school.com, and then you'll have access to all that. So the other thing that I wanted to point out is I put in a module on family management company strategies and S corp strategies this week. So when it comes to S corps, if you look at the ultimate tax plan framework that I developed, the S corp is generally going to be, in most cases, we always have to put those qualifiers because all of this is for educational or purposes only, and we're not actually dispensing tax advice because I don't know your situation as you're watching this. But generally speaking, the core operational entity is going to be an S corp for a business, and there's various reasons for that. Largely because A, it's a separate taxable entity, and B, it's the profits from it are not subject to self-employment tax like a Schedule C or like a partnership would be. So, along with that, there's all these other things that come along with that, is like a reasonable compensation requirement. And in the S corp module, I talk about the stages of tax planning, being that first we want to do entity selection. So putting the right money flows into the right entity buckets so that we're maximizing our tax benefit. The second thing is deduction strategies, and that's going to be things like 139 plans, 127 plans, 162 plans, things like that. And those are going to reduce the amount available for profit. And then once we're all done with all those, the third step, which is what the S corp module goes over, is the optimization. Because we do have a reasonable compensation requirement. What does that mean? And how does that apply to a given situation? How much should it be? How do we calculate how much should it be? And then how do we balance that with qualified business income deduction purposes? And how do we tie in retirement contributions? Because generally speaking, a 401k is going to be the most efficient retirement contribution structure because you can contribute both as the employee and as the employer. Most other things, you don't have that flexibility to hit it from both sides. So, the course goes into all of that. And then the family management company strategy ends up being on net. It ends up being a deduction strategy, which is going to come in that second step of tax planning. But it's going to depend on your particular facts and circumstances as far as what your family structure is like. If you have kids the right age, can we put them on payroll? What would they be doing? How much should they be paid? All those kinds of things are in that family management company strategy. So and it goes into how we operate that company in order to maximize the benefit and minimize any potential downsides. So those are the updates in the school.com modules, and I recommend you check them out. So that's all I got for this week's coffee break. I think my coffee might be cold by now, but so we're gonna be doing these weekly. I think I'm liking the Riverside setup. So last week I did it on the school platform, and I couldn't get the recording out. It just kind of disappeared into the ephemeral RAM, I guess. So I think I'm going to stick with this setup, but stay tuned for future updates. And I'm doing these each Friday at noon Eastern, because I'm in Atlanta. So we'll see you next time.